If one of the greatest investors of all time is telling you that all you need to do is buy the S&P 500, then it's probably worth a listen.
So if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
And as good as all that sounds, is it too good to be true, or can you really just buy the S&P 500 as your only investment and then go back to watching Vecna terrorize the kids of Hawkins? I'll be honest, I really need to just get that Kate Bush song out of my head. So let's focus on investing, and hopefully all of the data will make sense in the end. The S&P 500 is an index, or in really simple terms, a collection of companies headquartered in the US that include some of the world's biggest brands. Its names come from the fact that it's actually managed and tracked by the company Standard & Poor's, and it's been running since 1957. It's got 500 companies tracked inside of the index, but if you've got a keen eye, you'll actually notice that there is more than 500 listings on the index itself. But this is because some of the companies have more than one listing. If you take Alphabet, for example, which is the parent company of Google, they've got both Class A and Class C shares with the ticker symbols GOOG and GOOGL. Now, you end up buying the same company, but with one kind you'll get more voting rights, but let's not worry too much about that one for now. Inside the index, you've got lots of companies that operate in multiple different industries, everything from the technology sector, industrials, pharmaceutical, healthcare, and consumer goods. What's really interesting is to see that how over time, since the index was created, the changes in the kinds of companies that make up the list. Now have a look at this. This is a chart showing how the index has changed over time. You can see how many different companies used to be in the industrial sector, for example, but over time, the US economy changed with the rest of the world. More services companies were born, others merged or got acquired, and then the boom in the information technology sector has changed everything. You can see here that the industrial sector, so things like oil, gas and steel manufacturing, have been cut more than half in numbers of companies on the list, whereas companies in the tech sector have more than trebled. Have a look at this on another graph and you'll see just how much the index has changed, and this brings me on to one of the first arguments about the index and how powerful it can actually be. What you're seeing here are all of the companies that have been added to and also removed from the index. Whether they were acquired by another company or merged into one another or even went bankrupt, companies come and go all of the time. In fact, I did a video on this topic recently because I think that you'll be really surprised about how short the average company's life actually is. Only very few of them last a very long time. The point here is that if you just buy the S&P 500 rather than individual stocks, the index will clean itself up over time and you won't have to worry about which companies you need to sell or start to buy. The S&P committee, who look after the list of companies, will do it all for you. However, let me just highlight one of the negatives here for you. The S&P 500 isn't quite as passive as you might think. If you thought it was just made up from the largest 500 companies in the US, you'd actually be wrong. There is some human intervention here that takes place and actually gets to choose who goes on that list. One of the more recent criticisms has come from how late Tesla was added to the S&P 500. It was actually the single largest company to have ever been added to the index because its market cap had been pushed up so high by the increase of investors into the company. The reason this took place so late was because the committee at the S&P don't just look at the size of the company, they also have other things they look at too, including the financials, and Tesla had to post 4 quarters of profits before they met that final hurdle. Once they'd done this, then they were added on and another company was removed from the list. Some people were annoyed about adding Tesla so late because they argued that index fund investors missed out on all of the gains before it was added, which were pretty substantial. Just before we jump to the next point, if you are enjoying the video, please consider dropping me a big fat like, and also don't forget to comment below, it really helps out small channels like mine. Anyway, with that like button turned blue, let's dive back in. On to the next major point, let's look at whether or not this index is enough if you want a truly global portfolio. One of the biggest pieces of advice that you'll hear from all investors is that you need to be globally diversified, and this is absolutely true. You don't want to rely on a single country or a single region of the world for your growth because, as we've seen over history, the growth engines in the world have changed dramatically. Basically, anything could happen, so it's best to own all of it. However, it's a bit of a myth that the S&P 500 only invests in US companies and relies on the US economy. Just because a company is headquartered in the US doesn't mean that it only makes a profit from inside of the United States. It's exactly the same as here in the UK with companies headquartered in London, But let's explain the S&P 500 first. Think about this first. Obviously, big companies like Apple, Microsoft, and Google make a lot of money outside of the United States. We've all probably used or have an Apple product on us right now. We're all watching YouTube, which is owned by Google, and there isn't a major business that doesn't at least rely on Microsoft to some extent for its software. If you look back over the past couple of decades, you can see that international sales make up a big part of the S&P 500. During the period of 2001 to 2010, you can see here that the average amount of international sales made outside of the United States is about 40%, while in some years it's actually been the majority of sales. In 2003, 2007, and 2008, international sales made up more than 50% of the sales for the S&P 500, as you can see from these green bars. Now that definitely surprised me. So what this means is that by owning the S&P 500, you do also get exposed to other parts of the world. So it's not as concentrated or reliant on the US market as you might initially think. You can definitely make the argument that the S&P 500 and US stocks in general look expensive when compared to the rest of the world, and lots of people like to talk about this specific point at the moment. There's no guarantee that the US stock market will continue to keep delivering high returns that beat the rest of the world, but then there's also nothing to say that they can't keep going strong either. So far in 2022, we've seen this correction play out, and lots of stocks that have had very high prices have now been brought back down to earth, whereas some other markets like the FTSE 100 for example haven't quite taken that hit. But then remember that it's because they contain very different kinds of companies. Another major reason that it might be the only investment you need is that it's easy and cheap to buy. And no, I'm not talking about the valuations of the companies here. I'm talking about the fees and the charges of investing. Because the S&P 500 is one of the most popular indexes in the world, there are so many mutual funds and ETFs that track it and allow investors like you and me to buy a small share for a very low amount of money. If you're based in the US, then you get access to popular ETFs like the VU, which is Vanguard's S&P 500 tracker, which currently costs you about $370. Or if you live here in the UK, we've got access to funds like VUSA, which is exactly the same but available to us here for the low price of just £60 a share. Now, I don't know about you, but I would personally say that for a small amount of money, getting a share of 500 companies for that amount seems pretty reasonable to me. But it's not just the initial costs that are important. Ongoing costs are one of the single most important things to consider when investing. Thankfully, ETFs like VU and VUSA are both super low cost for ongoing investors. VU has an ongoing expense ratio of just 0.03%, while here in the UK, VUSA costs us 0.07%. If you tried to build your own portfolio, you could cost yourself a lot more in transaction fees and brokerage costs, so do bear that in mind. And that's not to mention the fees that an active manager or even a financial advisor might charge. It's not all a walk in the park though, there are some more downsides to consider. It's all part of making sure that you do your own research to find out what works for you. One big criticism that gets spoken about a lot is that the S&P 500 is heavily concentrated in just a few stocks, and most of these are all technology giants. If you look at the top of the list, you'll see that the top 5 companies make up 20% of the entire market cap of the index. Apple, Microsoft, Amazon, Tesla, and Google are responsible for a huge amount of capital, and many people argue that because the index is market cap weighted, lots of investors' money continues to flow into these companies even though they might already be heavily overvalued. It's a fair criticism and a whole video subject in its own right about the benefits of active or passive management and how index funds affects the wider stock market. However, to counter this, you have to ask yourself whether or not you're happy with that level of diversification. At the end of the day, it's completely up to you and where you are on your own journey. Also, let's address a couple of other concerns that you might have too. Because the index is just 500 companies, it does miss out on the rest of the thousands of smaller businesses that have tended to do very well over long periods of time. A good comparison to look at might be the Russell 2000. Now, this is a collection of smaller companies that have been tracking their performance since 1979. Smaller companies can, in theory, grow faster, be more agile, and also be able to adapt better, but it all really depends on the wider economy. Check this out. Overall, you can see different periods where the Russell 2000's beaten the S&P 500. During 1979 to 1983, it outperformed the S&P 500 by 80% during a period of double-digit inflation and high interest rates. But then again, during different time frames, smaller companies can suffer too. They tend to be a lot more volatile, but they can give you some good returns in the long run. It all really depends on the timescales. If you go back to the year 2000 up until today, you'll see that smaller companies are slightly in the lead, but they've also taken more of a hit recently. So if you do go down this road, make sure to be prepared for lots of volatility and wear a seatbelt. Let's not also forget a little point too, that the S&P 500 does pay you some dividends, and what you do with that extra cash is up to you. It's not going to be any kind of game changer as it's currently just 1.3%, but If you've got enough invested, you could use that as a source of income, or you could just reinvest that money and take advantage of the compound interest over time. Having $10,000 invested would net you around $130 based on that yield for the year, so it might pay for a full tank of fuel at the gas station where you live, or if you're based here in the UK, you'll probably get about half a tank at the moment. Every little helps, I guess. So is that everything then? Well, let me just address this final point for you. Another reason this index might be the only investment you ever need is that it's so difficult to beat. If you watch my videos regularly and you love your data, you'll know that most professional money managers, hedge funds and actively managed portfolios fail to beat the returns of the S&P 500 year after year, and it gets worse for them in the longer term too. Have a look at some of the latest data looking back across the last 20 years here. What you're looking at is the amount of funds that underperform their respective market indexes. The more orange, the worse it is for the active fund managers, meaning that you would have been a lot better off just using an index fund rather than paying high fees for someone else to pretty much lose you money. The worst funds seem to be the ones trying to beat large cap growth funds. 99.71% failed to beat the market. You might want to have a look at this the next time you try and pick out an actively managed fund, or consider throwing all of your life savings into Cathie Wood's ARK investments. The bottom line is that the S&P 500 has proven itself to be a great index, and it's delivered great results to investors who have invested consistently over the very long term, and that part's really important. Anything could happen in the short term, and there'll be plenty of times when it could drop, just like we're seeing right now in the markets. It's well diversified, gets income from both the US and around the rest of the world, and has lots of different industries represented, but at the end of the day, it all comes down to your own risk and what you want to get out of the market. Having everything in the stock market if you're looking to retire soon and not considering other asset classes could be a big issue, so please make sure you seek help from a professional advisor, as I'm definitely not one of those. I've personally got many decades ahead of me, so touch wood, I'm pretty much all in the market at the moment, with the majority of my wealth sits within these different companies. If you want to follow my progress, don't forget to check out my latest Vanguard portfolio update, which you can find here if you're interested in seeing how I actually invest my own money. Or if you like diving into some more data, then don't forget to check out this video, which actually looks at some of the risks involved in owning individual stocks for life. I think you might be surprised with some of the results. Anyway, please don't forget to drop me a big like on the way before you go, subscribe for many more videos, and as always, happy investing.